Hey everybody, how you doing? Welcome back to the channel. Today we're talking about how you can turn your own portfolio or portfolios into cash flow. What we want to do is take an ETF like the iShares Silver Trust at $29 per share, and we want to earn income from our portfolio. And you might not need as much as you think, especially with this ETF. That's what is exciting with this ETF. Now, first of all, we have to kind of go back and figure out what's been happening with the price of silver. We know the price of silver since March has been going up, as you can see from the chart, going down from 20 bucks, this ETF SLV, all the way up to $29 per share. And this is very good news if you're a silver investor. With that being said, we can look at this index and we can also think to ourselves, there's no yield on this ETF. That's the problem. There's no way to earn income. I'm just holding a rock and I want to earn something from this. How can I do that? Well, the good news is you can do that by selling cash secured puts and covered calls. And the idea here, and I've talked about this in other videos, if you watched my video on GLD recently, I probably sound like a broken record. But nonetheless, we can leverage these ETFs to earn income while gaining exposure to the price of gold. Or silver, sorry, and gold. So you can do this with pretty much any index, and that's what I tell people, and that's the beauty. You can do this against SPY, you can do this against QQQ, and quite honestly, it might be more beneficial and better long-term just to have those buckets to draw from, because you never know which assets may outperform. And so that's why investing in many different ventures, not just one or two. I think even in Proverbs, there's a verse that says pretty much exactly that, where you don't want to invest in just one or two ventures. You want to invest in a lot of ventures because you don't know for sure what's going to come across the land. So you can pretty much do this in terms of any ETF. But nonetheless, when you're looking at earning yield from gold and silver, this is one way actually that a very creative, not ETF, but ETN actually, exchange traded notes. These are different than ETFs, believe me. SLVO, this one's been around for a while, since 2013, but they pay on a monthly basis. The ETF share price has not done quite well, but if you look at the strategy, what they're trying to do is they're basically using an index. Now this index is based upon, so it started off with Credit Suisse NASDAQ Silver Flows Index, right? So that's when I think Credit Suisse actually owned this outright. I think they probably sold this, it looks like, to UBS, through its Nassau branch. So they pay a variable monthly cash coupon based upon the option premiums from selling against this index. Under SLVO is the ticker symbol. So the ETN should be purchased only by knowledgeable investors who understand the risk of investing in ETNs. There's a prospectus. I will leave this link in the description, but this is kind of an example of what they're trying to do, is to earn, let's say, covered calls, right? Income from this ETF against the price of silver. Now, if we look at this bid price of 25 cents. Right here is where it gets interesting, because the price of this ETF, or pretty much you could say the price of 1 ounce of silver roughly, is $29.10. If we look at spot silver, it might be a little bit different based upon the ETF and the way it trades, but spot silver price right now is going to probably be around 30 bucks. It says around 31. I guess that's probably around accurate. Nonetheless, what we have here is a put option that we're selling 10 contracts at $29 per share. Now, what we're doing on October 4th, that's the expiration. So that's when this option expires. Now, if this ETF does not go below $29 by tomorrow, then nothing happens. We actually keep the money from these 10 contracts that we sold, which is the equivalent of 1,000 shares. Because once again, each options contract is worth 100 shares, so 10 times 100 is 1,000 shares that we're agreeing to buy at a price of $29. So you're basically getting paid to agree to buy this stock up until tomorrow. So I always use this analogy. Instead of paying your broker a commission, you are getting paid to buy a stock, because this option expires tomorrow. Worst case, you're getting a 10-cent discount on the stock right now, and you're getting paid $243.50 after commissions, because your max gain is $250 minus the $6.50 of commissions that Fidelity charges to facilitate the transaction, and your total is $243.50. So, with that being said, you have a real opportunity here, because if you're looking at the bid price of 25 cents for this option that expires on October 4th, 2024, since today's October 3rd, you have today's trading day, about a day and a half roughly, until this actually expires. And you're already just basically pushing back the date of this contract a day and a half. And in the process of doing that, you could pretty much say that you bought this at $29 and you got paid $243 for doing so. And so if you were going to be an investor in SLV, wouldn't it be better to go ahead and do this instead of actually just going out and buying the shares? Because if it expires tomorrow, quite honestly, what's the difference, right? That's kind of the way you can look at it. And that's the way I kind of shifted my mindset from this, is like, instead of paying my broker a commission like the good old days, now we can get smart and think about how we can actually pocket cash every time we're buying a position, as long as it's 100 shares or more. In this case, 1,000 shares gives you pretty good leverage. If you did a ridiculous amount, like $100,000 into this ETF, you would just take $100,000 divided by, let's say $29, and now you have 3,448 shares divided by 100, allows you to sell 34 contracts. So if you're selling 34 contracts, now it gets pretty serious, because in one single day, you just pocketed $827 after commissions. So this is a way that a lot of traders on Wall Street will use to pretty much increase their returns. That's the goal. Now, that's the first part of it. Then we switch over to calls. I've discussed this in my other videos. I have links in the description. But if you look at 34 contracts with a call option at 29, now that's in the money a little bit. If you go to 29.50 expiring tomorrow, you're still getting $419. Now that's about a $100,000 position, so not insignificant by any means, especially for most people these days, with how much inflation has robbed the average consumer and all that kind of stuff. But if we're looking at earning this cash flow, it can be done. It can be done often for a lot less than you think. With 10 contracts on the covered call side, we're still earning over $100 for an option that expires tomorrow. And that's at the 29.50 strike. So assuming we already own the 1,000 shares in this case, we're now agreeing to sell our shares at a price of $29.50 or 40 cents. Worst case, we're going to lock in that 40 cents from the current share price of $29.10, and we're going to collect this $123.50 after commissions. So that's how you can do it, guys. It's very simple once you get the hang of it. But this is the wheel strategy in rotation against these indexes: silver, gold, SLV, GLD. You can do this against the index because it allows you to earn this yield that otherwise would not be possible. And that's the beauty of it. So let me know what you guys think in the comments down below. I know I talk a lot about the wheel strategy on this channel. It is one of my favorites, and I love comparing different ETFs and what is possible, because if you look at these expirations, you can pretty much sell these options every couple days. And as long as you're doing, let's say, $200 a trade, and you're coming out on top, let's say, a majority of the time, in worst case, you're switching to selling a covered call right after to mitigate the risk and collect additional premium as a hedge. See, that's the goal, right? Is hedging and also trying to get that premium extracted from each trade and have that win rate. And you can kind of think of it as if you're the house. You want to think of yourself, if the buyer of the put option or the buyer of the call option is the person going to the casino, then you are the person selling the buyer of the put or the call option. You are the one collecting the money. In a lot of cases, especially due to the time decay that occurs in the last day before expiration, you will come out ahead. And that's the beauty of it as well. So let me know what you guys think of this in the comments down below. Once again, this was done against SLV, or the iShares Silver Trust. Check it out in the description if you guys are interested on more information on the wheel strategy. If you want to learn more about this ETN I talked about, this is obviously not a recommendation. SLVO, you can check that out as well, the one I discussed right here. But thank you so much for tuning in. God bless, and we will see you in the next video. Take care.